You have just spent $26 million to buy a demolition company. The website shows skyscrapers folding into clouds of dust, stadiums disappearing before breakfast, industrial towers falling exactly where an engineer expected. The videos make the business look simple. A client owns an unwanted building. You place the company logo on the fence. Someone starts a countdown. The building falls. The invoice gets paid. But the dramatic part may last less than 10 seconds. The project can occupy your company for 10 months. Before anything falls, you may need to win the bid, study incomplete drawings, survey the structure, document neighboring buildings, inspect for asbestos and other hazards, disconnect utilities, remove equipment and interior materials, coordinate police, fire, transportation, and local regulators. Design the demolition sequence. Protect roads, rail, utilities, and structures that must remain. Buy project-specific insurance. Post performance bonds. Mobilize heavy equipment. Build a public safety perimeter. And convince the owner that your plan will not turn one unwanted building into several damaged ones. The explosion is not the product. Risk control is the product. In our base year, your company produces $32 million of revenue. Only 3 projects involve controlled explosive felling. Most of the money comes from ordinary-looking work: mechanical demolition, industrial dismantlement, material processing, emergency stabilization, hauling, recycling, consulting. After field labor, subcontractors, equipment, disposal, insurance, overhead, capital spending, and acquisition debt, the owner receives approximately $1.6 million of pre-tax cash, a return of about 10% on $16 million of equity. That is the good year. On one $6 million industrial project, hidden asbestos and undocumented structural changes can add $2.4 million of work. If the owner approves only $800,000 of change orders, the unrecovered cost wipes out the entire year's owner cash. On another project, the structure can be ready while the city, utility company, or public safety plan is not. A postponement can add hundreds of thousands of dollars in standby and remobilization costs while delaying a multi-million-dollar milestone payment. The company can remain profitable on paper and still run out of cash. This is the paradox. The public pays attention to the moment the structure falls. The owner earns or loses money in every decision made before and after that moment. So today, you are not buying a button that destroys buildings. You are buying the stock of one integrated demolition contractor with 48 permanent employees, a heavy equipment fleet, bonding capacity, insurance relationships, a federal explosives permit, and 14 projects a year. The licensed corporation remains intact, but the change of control and new responsible persons must be reported to ATF, and required state and local approvals must remain valid. We will determine what the client actually buys, why an engineering survey is more valuable than the dramatic footage, how asbestos changes a bid, why the prime contractor and the explosive specialist may be different companies, how scrap can reduce cost, why change orders decide profit, and how one delay can create a working capital crisis. Then we will test 2 separate downside years, each beginning from the same base case. A building that is not what the drawings promised, and an implosion date that moves after the project is already mobilized. Finally, we will compare 4 ways to enter the business: an integrated demolition prime contractor, a specialist explosive felling subcontractor, a conventional mechanical demolition company, and an asset-light engineering and consulting practice. By the end, you may still want to blow up buildings, but you will understand that successful demolition is not about making a structure fall. It is about controlling everything that could fall with it. The first mistake is assuming every contract ends with a countdown. Explosive demolition is rare. Most structures are removed mechanically, piece by piece, with excavators, cranes, cutting equipment, and hauling crews. Even when explosives are used, the explosive specialist may not hold the main demolition contract. The prime contractor may control environmental remediation, interior stripping, utility disconnection, permits, site logistics, excavation, debris processing, hauling, final grading. The explosive contractor may be responsible for one specialized package inside that larger scope. That is how the Tropicana Las Vegas project was structured. The main demolition contractor controlled the overall work. Controlled Demolition, Inc. performed the explosive felling package. The public saw 2 towers fall. The client purchased an integrated demolition project. Our company is integrated. It owns heavy equipment and performs conventional demolition. It can also execute or manage explosive felling scopes where that method is approved and economically justified. That matters because 3 explosive projects do not support 48 employees all year. Mechanical demolition creates backlog. Industrial work creates longer projects. Emergency work fills gaps. Consulting creates high-margin revenue with little. Equipment. Material recovery offsets disposal costs. The spectacular service wins attention. The ordinary services keep the company alive. The business therefore begins with a question that has nothing to do with explosives. What exactly is the client asking you to remove? The client rarely wants demolition for its own sake. The client wants something after demolition: a new stadium, a factory expansion, a residential tower, a safer industrial site, a cleared parcel, a bridge replacement, a damaged structure removed before reconstruction. The demolition contract is one step on a larger critical path that changes the value of speed. If the replacement project is worth hundreds of millions of dollars, saving 2 months can be worth more than saving $1 million on demolition. The Kingdome illustrates the point. The project required extensive analysis and community coordination. The prime demolition contract was approximately $9 million. According to CDI, the resulting debris was processed and removed months ahead of the schedule required for the replacement stadium. The client did not buy a famous implosion. The client bought access to the site sooner. This is why an expensive demolition method can be the cheaper project decision. A slower method may require longer road closures, more crane time, more work at height, more exposure to wind, more months of security, more interference with surrounding operations. The contractor's proposal must therefore compare total project impact, not only its own price. The best demolition company does not sell destruction. It sells a predictable handoff from the old asset to the new one. And predictability begins with understanding the old structure. Before employees begin demolition, OSHA requires a written engineering survey by a competent person. The survey examines the condition of framing, floors, and walls, and the possibility of an unplanned collapse. Adjacent structures must also be considered where workers may be exposed. This is not paperwork added after the real work. It is the first layer of the real work. OSHA says the preparatory operations standard accounts for as much as 3/4 of demolition citations. The engineering survey requirement accounts for more than half of that group. That tells us something important about the industry. The most common compliance failure happens before the building is removed. A demolition bid may begin with original drawings. The building may have changed for 50 years. A wall was added. A column was modified. A floor opening was filled. Equipment was installed. Fire damaged one section. Water weakened another. Previous renovations removed records. The owner may not know. The contractor cannot price unknown conditions as if they are known. A strong contract distinguishes between information supplied by the owner, conditions observed during the survey, assumptions used in the bid, and conditions that create a compensable change. Without that distinction, the company accepts unlimited structural uncertainty for a fixed price. That is not courage. It is a badly written contract. The engineering survey protects workers and the public. It also defines the financial boundary of the bid. Because a building that differs from the drawings can differ by millions of dollars, the unwanted structure is only one object on the site. Everything around it can become your responsibility. Gas, electricity, water, sewer, steam, telecommunications, rail lines, roads, sidewalks, neighboring buildings, historic facades, operating factories, hospitals, homes. OSHA requires service lines to be shut off, capped or otherwise controlled outside the building line before demolition begins. Local agencies may impose additional requirements. Utility coordination can take longer than physical demolition. One company owns the electric line, another owns gas. A public agency controls the road. A telecommunications provider may not know exactly where an old cable runs. The demolition contractor cannot solve these conflicts by arriving with a larger excavator. Neighboring property creates another financial problem. Before work, the contractor and owner may document existing cracks, settlement, and damage. During the project, monitoring may track vibration, movement, dust, or noise. After the project, inspections determine whether conditions changed. This documentation is part engineering and part claims defense. If a neighboring owner reports a new crack, the question is not only, did demolition cause it? The question is, what evidence existed before work began? A few days of careful baseline documentation can protect millions of dollars of insurance capacity. That is why risk management appears everywhere in a strong demolition bid. The company is not only planning how to remove the target, it is proving how it will protect everything else. A building can look empty and still contain an expensive inventory. Asbestos-containing insulation, flooring, pipe material, roofing, fireproofing, lead coatings, contaminated equipment, industrial residues. EPA's asbestos rules require a thorough inspection for covered demolition and renovation projects. Regulated material can require notification, controlled removal, packaging, transport and disposal before general demolition continues. This creates two separate businesses on one site: abatement and demolition. Our company can subcontract licensed abatement work while retaining responsibility for the overall schedule. Or the owner can contract abatement separately. The contract must make the boundary clear. Suppose the owner's survey identifies $100,000 of regulated material. Your bid assumes that amount. During interior stripping, crews discover material in inaccessible areas that were not sampled. The new condition can stop work. The abatement contractor remobilizes. Air monitoring expands. Waste volumes increase. The demolition crew waits. Equipment remains on rent. The replacement project loses time. Who pays? The answer depends on the contract, documentation, and notice procedure. A profitable demolition company is often a change order company. Not because it invents claims, because old structures reveal conditions that no responsible estimator should pretend to know in advance. The owner wants price certainty. The contractor needs protection from concealed conditions. The contract must allocate that tension before the wall opens. The federal application fee is not the economic barrier. ATF lists a 3-year federal explosives user permit with a $100 application fee. That sounds trivial. The permit does not mean anyone with $100 can enter the business. ATF reviews the applicant. Responsible persons, employees authorized to possess explosive materials. Premises, storage, record-keeping, and compliance with state and local law. Applications can involve background checks and an in-person qualification inspection. Materials must be stored under federal rules when they are not lawfully in use, transport, or active handling. State and local authorities can require additional blasting licenses, permits, notifications, and public safety plans. The cheap fee reveals the real barrier. The asset is not the paper permit, it is the organization capable of keeping the permit. Qualified people, clean records, secure storage, reliable inventory controls, regulatory relationships, training, insurance, a history of safe projects. A new competitor can buy an excavator. It cannot instantly buy decades of credibility with owners, sureties, insurers, regulators, and public agencies. The permit also changes how you structure an acquisition. In our stock purchase model, the licensed corporation survives the transaction. The company must report the change of control within 30 days, identify new responsible persons and authorized possessors, and complete any required follow-up. In an asset purchase, the buyer cannot simply place the seller's permit in a new company's name. The new entity needs its own authorization before performing covered work. That makes transaction structure part of operating continuity. That credibility determines which projects the company is allowed to bid and which clients are willing to accept the risk. On a small demolition project, the owner may require ordinary construction insurance. On a complex urban or industrial project, the limits can become enormous. Controlled Demolition, Inc. reports placing general liability limits above $100 million for demanding clients. It also reports providing single project payment and performance bonds up to $30 million. Those figures describe a leading specialist. Our company models $15 million of single project bonding capacity. Bonding capacity is not the same as cash in the bank. It depends on financial strength, working capital, profit history, backlog, management, claims, and the surety's confidence that the project can be completed. A performance bond protects the client if the contractor fails to perform. A payment bond protects subcontractors and suppliers. The surety does not intend to lose money. If it pays a valid claim, it can pursue indemnity from the contractor and owners. That means a bond does not transfer the business risk permanently. It proves that another financial institution has reviewed the contractor and is willing to stand behind the obligation. Insurance works differently. It covers defined risks subject to terms, exclusions, and deductibles. One incident can still create uninsured costs: schedule loss, reputational damage, deductibles, disputed coverage, loss of bonding capacity, higher future premiums. The owner's strongest asset may not appear on the equipment list. It is the ability to obtain insurance and bonds at a price that still leaves a margin. An explosive felling project is not performed on the building exactly as the owner used it. The structure must be prepared under an engineered plan. Non-essential materials may be removed. Selected components may require controlled alteration. Access and protection systems must be installed. Dust, debris, and public safety measures must be prepared. The exact methods are project-specific and handled by qualified professionals. For our business model, the economic point is simple. Preparation labor can exceed the duration of the dramatic event by thousands of times. Preparation also creates the largest scope disputes. Who removes interiors? Who performs abatement? Who opens access? Who handles unexpected reinforcement? Who protects underground utilities? Who installs monitoring? Who owns the debris? Who repairs roads? Who pays if the date changes? The explosive specialist may price only the engineered felling package. The prime contractor may price everything else. Or an integrated company may accept the entire scope. The integrated model captures more revenue. It also captures more unknowns. That is why our company does not select a method because it looks impressive. It selects the method that creates the best risk-adjusted result for the whole contract. By the day of the implosion, the project should be boring. The building is empty. The perimeter is controlled. Utilities are confirmed. Public agencies are coordinated. Roads and access points are secured. Monitoring is active. The team works through final authorization. The public sees a countdown. The owner sees months of conditions that must all remain true at the same moment. If one condition fails, the event can be postponed. A person enters the exclusion zone. A utility status changes. Weather exceeds the plan. A public agency withdraws approval. A safety concern appears. Postponement is expensive. Proceeding when conditions are wrong can be catastrophic. The owner must create a culture where the decision to stop is financially painful, but operationally normal. The successful event does not complete the contract. It changes the type of work. A standing structure becomes a debris field. Heavy equipment enters. Steel is separated. Concrete is processed. Waste is hauled. Foundations may remain below grade. The client may not release final payment until the site reaches an agreed condition. The building fell in seconds. The contract continues for months. The Seattle Kingdome is useful because it reveals how little of the project was the public event, according to CDI. The team spent more than a year and a half analyzing the structure, site conditions, surrounding improvements, and public impact before explosive felling was selected. The prime demolition contract was approximately $9 million. The site sat near critical infrastructure and neighboring structures. The project team needed to manage community, schedule, and physical risk. The Kingdome disappeared in a short event. The business value appeared afterward. CDI reports that debris removal finished months ahead of the critical path schedule required for the replacement stadium. This is the ideal demolition outcome. The old asset is removed. The surrounding city continues operating. The client receives the site early. The contractor completes the scope. The dramatic footage becomes proof of execution. But the contractor was not paid for the footage. It was paid for converting a difficult obstacle into a cleared site without disrupting the larger development plan. The Florida Power and Light Lauderdale project shows the other side of the business. It was not simply one building folding into itself. It was an industrial clearance project with steel, non-ferrous material, reinforced concrete, foundations, and water-related work. CDI reports an original contract value of approximately $4.73 million. During performance, the owner awarded 6 change orders worth approximately $1.64 million. The final awarded scope was therefore more than 1/3 larger than the original contract. That does not automatically mean the original bid was wrong. Industrial sites reveal additional work. Owners change plans. Interfaces with replacement construction evolve. The important question is whether the contract provides a disciplined path to price and document those changes. The project also demonstrates material recovery. Large volumes of steel and non-ferrous material were processed. Concrete was crushed and retained for use in the new facility. This can reduce hauling, disposal, and material purchase costs. But scrap is not free profit. It requires labor, equipment, sorting, processing, transportation, and clear contractual ownership. The client may retain salvage value, the contractor may receive it, or the bid may credit an estimated value to the owner. If scrap prices fall after the bid, the party holding that risk loses money. Material recovery is a revenue stream only after the contract and processing cost are understood. Demolition creates material: concrete, steel, copper, aluminum, equipment, fixtures, mixed debris, hazardous waste. The owner and contractor must decide who owns each category. 3 common structures exist. Contractor owns salvage. The contractor bids a lower demolition price because it expects to recover material value. If prices rise, the contractor benefits. If prices fall, the contractor absorbs the loss. Owner retains salvage value. The contractor processes material for a fee. Commodity price risk stays with the owner. The contractor's upside is smaller and more predictable. Shared or credited value. The bid includes an estimated credit, reconciliation, or revenue-sharing mechanism. This can reduce disputes if measurement and pricing are clear. Concrete creates another opportunity. Crushing material on site can avoid disposal and provide fill or aggregate for future construction. That can save trucking, landfill fees, and new material purchases. But crushing requires equipment, dust control, testing, space, and time. The material has value only if someone can use it economically. Our model includes $2.5 million of net material recovery revenue. A 30% decline in the recoverable value of the company's material portfolio would reduce annual cash by approximately $750,000 before any cost adjustments. Scrap is a useful hedge. It is not guaranteed margin. And recovering that value depends on the machines that process it. Heavy demolition consumes equipment: excavators, high-reach machines, loaders, crushers, shears, trucks, dust control systems, support equipment. Owning equipment creates control. The machine is available when the project needs it. Crews know the fleet. Attachments can be maintained for specialized work. The company captures utilization economics. Owning also creates fixed cost: debt, depreciation, insurance, maintenance, storage, transportation. A machine that sits in the yard does not become free. BLS reports construction equipment operators earning mean annual wages, around $70,000 in the broad construction sector. The operator's cost is only one layer. The machine itself must earn enough billable hours to justify the capital. Rental transfers part of the utilization risk. The company pays more per day but avoids owning a machine between projects. A growing demolition company should own the equipment used repeatedly across most projects and rent specialized or peak demand capacity. Our acquisition includes an established fleet. Before buying, inspect hours, maintenance records, undercarriages, hydraulic systems, attachments, emissions compliance, transportation requirements, and actual utilization by machine. The seller may show replacement cost. You should value productive hours. A $10 million fleet can be an asset. It can also be a delayed capital expenditure disguised as equipment. Before we calculate the company, one real failure shows why neither equipment nor backlog matters when preparation and supervision break down. In June 2013, a building under conventional demolition in Philadelphia collapsed onto an occupied neighboring thrift store. 6 people were killed, 14 were injured. OSHA reported that a remaining wall was not sufficiently supported, critical structural supports had been removed, and the required engineering survey had not been completed. This was not a controlled implosion. It is relevant because it shows what happens when demolition fundamentals are treated as delay or overhead. No financial model can reduce this event to a penalty line. People died. The business lesson is inseparable from the human one. The contractor sells control of a dangerous process. If the structure is not understood, supported, and removed under a safe plan, the contractor is not delivering the service. OSHA has continued to cite contractors after later fatal incidents where engineering surveys were not completed. The requirement is not obscure. The failure is not hypothetical. A demolition company can survive a low-margin project. It should not survive a culture that treats known safety requirements as optional. For our owner, the engineering survey, stop work authority, and competent supervision are not compliance expenses outside the business. They are the conditions under which the business deserves to operate. With that obligation fixed, we can calculate what the company earns in an ordinary year. Now we can calculate our company. 14 projects, $32 million of annual revenue. $22 million comes from integrated industrial and urban demolition. $3.5 million comes from explosive felling specialty packages. $4 million comes from emergency, consulting, and smaller work. $2.5 million comes from net material recovery and recycling, where the contracts allow the company to benefit. Direct project costs, field payroll, benefits, and travel, $8.4 million. Subcontracted engineering, abatement, and specialty work, $4.8 million. Equipment, fuel, repairs, and project rentals, $4.2 million. Hauling, disposal, and processing, $4.1 million. Monitoring, site controls, permits, and regulated materials, $1.5 million. Total direct project cost, $23 million. Gross profit is $9 million. A margin of approximately 28%. Then comes company overhead. Management, estimators, and office, $2.2 million. Insurance, surety, licensing, and professional costs, $1.2 million. Sales, legal, IT, and other overhead, $800,000. EBITDA, $4.8 million. Then the company spends $1.4 million replacing and updating equipment and technology. The bank receives approximately $1.82 million on the acquisition debt. Pre-tax distributable owner cash, approximately $1.58 million. Equity invested, $16 million. Cash yield, approximately 9.9%. That is a credible small company return. It is not a margin of safety large enough to ignore one bad project. At the modeled gross margin, annual revenue can fall to approximately $26.4 million before owner cash reaches zero, a decline of roughly 18%. But revenue decline is not the most dangerous risk. Project margin can disappear while revenue remains exactly on plan. Now we open a wall the drawings did not explain. One industrial project carries a $6 million contract value. The expected direct cost is $4.4 million. Expected contribution, $1.6 million. That single project is expected to produce approximately the same amount of contribution as the owner's entire annual cash distribution. Then the conditions change. Additional regulated material is discovered. Structural modifications do not match the drawings. Access is more difficult. The project pauses while the scope is re-engineered. Additional cost? $2.4 million. The contractor submits notices and change order requests. The owner agrees to reimburse $800,000. The remaining $1.6 million is disputed or unrecoverable. The project produces no contribution. Annual revenue rises from $32 million to $32.8 million after the approved change order. Annual direct project cost rises from $23 million to $25.4 million. The owner's pre-tax cash falls from approximately $1.58 million to approximately minus $0.02 million. Essentially, zero. One project did not destroy the company because the building failed to fall. It destroyed the year because the contract did not fully protect the company from a building that differed from the bid assumptions. The due diligence lesson is precise. Before acquisition, review the seller's change order history. How often are notices late? How much unapproved work sits in receivables? Which customers negotiate aggressively after the work is complete? How much profit comes from claims rather than clean project execution? A backlog can be large and still be dangerous. The amount signed is not the amount earned. Our second project is an explosive felling subcontract. Contract value, $1.3 million. The engineering and physical preparation are substantially complete. A final event date has been coordinated. Then a required third-party approval is delayed. The project moves 45 days. The company incurs extended supervision, additional site security, monitoring and inspection, equipment standby, demobilization and remobilization, updated public safety coordination. Additional cost, $650,000. The annual owner cash falls to approximately $0.93 million. Still positive, but the income statement is not the real crisis. A $1 million milestone and retainage package is also delayed until the event and post-event scope are accepted. The company therefore faces a temporary liquidity need of approximately $2.65 million. The delay does not bankrupt the company by itself, but $1.65 million consumes about 41% of the $4 million working capital reserve and leaves the company far more exposed to a second delayed project, a disputed receivable, or an equipment failure. This is why demolition companies need working capital. Payroll arrives every week. Fuel vendors expect payment. Equipment rentals continue. Subcontractors submit invoices. Insurance and bonds remain in force. The client pays according to milestones, retainage, and approval. A project can be profitable and still create a dangerous liquidity squeeze for an undercapitalized contractor. The 30-second public video does not show the months when cash leaves before the next milestone arrives. These two downside years are independent scenarios, not cumulative assumptions. But both risks can already be hiding inside the backlog you are about to buy. That brings us to due diligence. The seller asks $18 million for the operating company, brand, backlog, and fleet. The company reports $4.8 million of EBITDA. Before you buy, examine 7 categories. 1. Backlog quality. Which contracts are signed? Which are letters of intent? How much revenue depends on unapproved change orders? What work is bonded? Which schedules are already late? A backlog filled with disputed scope is not backlog. It is potential litigation. 2. Contract risk. Who owns concealed conditions? Who owns salvage? Who pays disposal increases? How are delays treated? What notices preserve change order rights? What liquidated damages apply? Does the contractor guarantee a date controlled by third parties? 3. Safety and compliance. Engineering surveys. OSHA history. Training. Stop work procedures. ATF permit status. Change of control notification plan. New responsible person and employee possessor reporting. The legal structure of the acquisition. Storage inspections. Environmental records. A company with weak safety systems is not a bargain at any EBITDA multiple. 4. Insurance and surety. Claims history. Deductibles. Excluded work. Bonding limits. Indemnity agreements. Collateral. Pending claims. Renewal pricing. Can the buyer retain the same insurance and surety capacity after change of control? 5. Equipment. Condition. Utilization. Debt. Replacement needs. Project allocation. A fleet that supports EBITDA must also support the next 5 years of work. 6. Receivables and retainage. How long do customers pay? How much cash is trapped in retainage? What invoices are disputed? How much working capital is required at peak? Backlog. Revenue does not pay payroll. Collected cash does. 7. Management and expertise. Which estimators understand industrial scope? Which supervisors manage large urban sites? Which people maintain regulator and client relationships? Who can sign or direct regulated explosive work? If 2 people carry the technical credibility, the business value can leave when they do. The seller markets dramatic projects. The buyer must value systems. A demolition company is transferable only if the knowledge, permits, client trust, and operating controls survive the transaction. You do not need to buy our exact company. There are 4 broad models. Model 1. Integrated demolition prime contractor. You control the overall project. Revenue is largest. You can capture demolition, processing, hauling, salvage, and specialty scopes. You also carry the most risk. Unknown conditions. Abatement interfaces, equipment, disposal, schedule, subcontractors, public protection. This model works when estimating and contract administration are excellent. Model 2. Explosive felling specialist. You focus on engineering, preparation oversight, and the controlled event. The prime contractor manages abatement, mechanical work, debris, and site restoration. Capital intensity can be lower. Reputation and technical expertise become more concentrated. Project frequency is lower. One mistake threatens the entire brand. Model 3. Conventional, mechanical demolition company. You avoid explosive work. The addressable market is much larger. Equipment intensity is high. Competition can be stronger. The business depends on fleet utilization, field productivity, disposal cost, and local relationships. Model 4. Engineering and demolition consulting. You assess structures, compare methods, develop budgets, and support owners or contractors. Capital intensity is lowest. Professional liability and expertise matter more than heavy equipment. Upside per project is lower. The model can be attractive for experienced professionals who do not want a leveraged fleet. For a first-time owner, acquiring an integrated contractor is dangerous unless the senior operating team remains. The explosive specialist model has the strongest brand, but the narrowest project flow. The mechanical model offers more repeatable volume. The consulting model offers the cleanest balance sheet. There is no universally superior structure. The right model depends on which risk the owner understands well enough to price. At the beginning, the business looked like a countdown, a building, a controlled event, a spectacular video, a large invoice. Now we can see the real company. 14 projects, 48 employees, $32 million of revenue. Only 3 explosive felling packages, $23 million of direct project costs, $4.2 million of overhead, $1.4 million of recurring equipment investment, nearly $1.82 million of acquisition debt service. The owner receives approximately $1.58 million in the good year. One concealed condition dispute can erase that cash. One postponed date can create a multi-million-dollar liquidity. Problem: one safety failure can harm workers, the public, and the company beyond repair. So, should you own a controlled demolition company? Only if the backlog contains enforceable scope, not hopeful claims. Only if the engineering and safety systems are stronger than the sales presentation. Only if change orders are documented before the extra work disappears behind debris. only if the equipment earns productive hours, only if insurance and bonding survive the acquisition, only if the company has enough liquidity to pay crews while clients hold milestones and retainage, only if technical credibility exists in a team, not one irreplaceable person, and only if the business can walk away from a dangerous schedule when the conditions are not right. The public believes the decisive moment is when the structure falls. The owner knows the decisive moments happened earlier. The survey, the contract, the permit, the abatement plan, the utility confirmation, the insurance binder, the exclusion zone, the stop work decision, the change order notice, the collection of the final payment. You are not paid because the building falls. Gravity can do that for free. You are paid because it falls once, inside the planned area, on the correct day, without taking the neighborhood with it, and because when the dust clears, the client can build what comes next. That is the business. The explosion is only the moment everyone notices.